Good morning, everyone, and welcome to the June session of the Ag Economic Dialogues. I think everyone has joined the session at this time and has their audio working. So I think we'll turn it over to our presenters today so they have the most minutes to use in this hour. Dr. Diersen and Dr. Wang are joining us today to be our presenters and look at some of those price protections. Even though prices are high, what can we be doing? So with that, I think I will turn it over to Matt. He has his microphone unmuted, so why don't you guys take the show away?
All right. Kind of a more technical oriented set of presentations today, but please don't get discouraged and slow us down if we go too fast or get too far into the weeds with some things. But we're looking at prices and price protection in general today. And we've got a couple of presentation things ready to go. We got high prices across most commodities right now. We've also got inverted markets, which kind of comes into play a little bit. You've got less incentive to be looking at storage at this point for the fall. And the other thing that's kind of really happening right now is the Federal Reserve is raising interest rates, which is driving up the cost of borrowing, which is leading to more of an incentive to forward price rather than store a given set of commodities. So some things are going on there. I'm going to start a slideshow presentation specifically talking about some different types of short-dated options. So there's regular options out there on corn and soybeans and cattle, and then there are short-dated options. And we'll get into the specifics here, but we're going to start with weekly options. So those are options that expire 1 week from now or 2 weeks or 3 weeks from now, and they're pegged to the nearby futures contract. So that's where we're going to start. Weekly options on grain futures. So I'm going to share my screen here, and Heather's going to yell at me if I don't have the right set of screens up there, but this is weekly options on grain futures. Myself and Dr. Wang put together a presentation for the spring for the North Central Coordinating Committee on Price Risk Management. We presented this down in our version of this down in St. Louis, and we've modified it a little bit for an extension audience, and we hope you find it interesting. Why might you look at something like weekly options? Well, there's short-term events in the summer months. I saw Eric Gerlach was on, so in a nod to NAS, we've got every month during the summer, you've got a crop production report that comes out mysteriously in the second week of the month, the same day that those crop production reports come out. For example, we had one on June 10th. You also have a WASDE report. And later in the month of June, you've got June 30th, you've got an acreage report and a grain stocks report. So those are kind of major reports. There's more crop production reports, middle of July, middle of August, that you might want to hedge or position ahead of. And one way to do that is using weekly options or short-dated options, as we'll get to. With regular options out there, you've got, say, December corn and November soybeans. You might also be looking at maybe hedging some old crop yet, probably not. But the exchange has looked to add additional ways to parse out when you might put hedges in place. So they've added short-dated new crop options. They added serial options. So if there's not an option, regular option expiring in a given month, they've added serial options to fill in those gaps. And the third type is weekly options. So these settle on Fridays when there's not a regular option or a serial option expiring. So expiring at the end of week 1 and week 2, sometimes week 3, occasionally week 4, and sometimes week 5. Trading platforms, depending on the platform you might use or log into, and the CME is an example of this, it might default to a weekly option or a short dated option or a serial option, and you'll be like, oh, I didn't know that the contract was only 3 days away from expiration. Well, you got to double check these days because it might be defaulting to something that's not a normal or standard expiring option. We call it platform creep, really. And we've also had broker anecdotes talking about how their customers are doing some positioning ahead of or prior to events like a WASDE report or the June acreage report. The exchanges tout some of the benefits of looking at some of these short dated options: lower capital outlay. It's less expensive to buy 2 weeks worth of coverage than 9 months worth of coverage. There's a little better sensitivity to the duration or tenor is sometimes how it's called. It's matching up your risk to when prices are going to be volatile, which we'll see. And then higher gamma. So that again figures into how much time value and how close to the futures price you're picking up the different options. What's available or what's out there? Well, across the board, here's a snapshot from the CME. We've got the grains and livestock. So there's corn. Could somebody out there in the hinterland please check that you're muted? We're getting some feedback here. But we've got grains and oil seeds. So we've got weekly options listed for corn, Chicago wheat, soybeans, soybean meal and oil, and finally Kansas City wheat. And then you can see hidden over there on the right-hand side, if you were to pull down the livestock menu, it would show live cattle weekly options, but those haven't been trading for quite some time. But they're still sort of technically listed, and they could be activated if demand were to come back. So I'm going to pause and turn it over to Gerald, who's going to walk through the next few slides.
Again, this is Gerald, faculty from Net School. Here we are talking about the corn and soybean trading volume, the options trading volume for the regular options and the weekly options, and also the open interest as well. And you can see the horizontal axis is the year, and vertical axis is just the ratio of the regular options to the weekly options. You can see both volume and open interest are in decline. Basically, it says the weekly options is gaining popularities relatively relative to regular options for corn. And so next night we'll be telling us the similar story for soybeans and declining relatively the regular options to the weekly options. Again, you can see clearly both volume and open interest are picking up for the weeklies relative to regulars. Next one. So the research on the weekly options are relatively scant, and we have some in the equity market, and that has been it's been done before, but relatively little on the commodity side, and also especially ag commodity side. So the weekly options on the equity, especially equity index, and we have Anderson and Todorov, 2017, they developed some theoretical framework to extract information from short-dated options, and especially S&P 500 index options, right? Because the short-dated options are very sensitive to the price move, near-term price move that could be, especially when there is event, and the price tend to jump, and sometimes we call that sort of tail risk, jump up or jump down. And so those two papers basically developed some theoretical framework for understanding the short-term options, right, which is different from the regular options. We're going to see later. And that's the options, weekly options on the equity side. And also something is of great interest to both traders and also producers is to predict the volatility. Basically, when we want to buy or use options and we want to hedge and when we pay for options to hedge or to speculate, and the core input to the option value, as we know, is volatility, right? We want to know for the next week and for the next month, or even further down, and what is the volatility is going to be like. And if it's high, we're going to probably pay higher premium for the options, protections, or speculating, right? And so, and there are papers on this, and Agrocrot and all, they talk about using implied volatility, which is the volatility calculated based on option prices, and is actually good for predicting future volatilities. And Todd, Rolf, and John recently used that to predict the volatilities for the S&P 500 index, right? So that's kind of where the literature is, and it's very relatively limited. And so we're trying to fill the gap in the research. So what are we trying to answer in this particular research is, we want to know if Weeklies actually provide something different in terms of information, in terms of predicting future volatilities, and in terms of its ability to hedge, especially around the particular events, right? So Weeklies, are they different from just regular options? In what way they are different? And also we want to see if we know weekly options are going to be useful for a particular type of event, hedging or speculation, and are they priced fairly? Sometimes we want to buy weekly options to hedge. Are we paying too much, right? Are they fairly priced? And that's the second question we want to ask. And the third one is a little bit more theoretical, and we want to understand, well, we have the information that is kind of embedded in the weekly options, and are they actually priced in the futures market? In other words, and do actually the volatility goes, let's see if volatility goes up, will that reflect in the futures prices, like corn prices, and if corn volatility increases, right? So those are the questions that we're trying to answer in this research. And the data we use to answer those questions are from CME, Chicago Mercantile Exchange, from 2017 to 2021. And we use both corn and soybean options and the futures. And a particular point we want to point out here, especially for the weeklies, as we know, for every month, there are potentially up to 5 weekly options. And as underlying futures expire, and we could have very different underlying futures from week to week. And so this is non-trivial to link the weekly option to underlying futures. And so that's the data we use. And here is just the list of the contracts, that is contract amounts for corn and soybeans. Pretty sure every one of you are very familiar with. For corn, we have March, May, July, September, and December contract, and offered or available for different time. For soybeans, we have a different contract amounts. Again, just highlight the point that as time goes by, the underlying futures contract that is associated with the options, weekly options are changing, right? Sometimes we may be using the most nearby contract. Sometimes we may have to roll over to the next contract, even though the nearby contract still exists technically. And that's, we spend a lot of time linking it so that the data is properly prepared. And talk about the key variables that we use for this research. And the first one is Black-Scholes implied volatility, which I'm pretty sure everyone is pretty familiar with. And that is available from the CME data set. We just use those CME calculated Black-Scholes implied volatility from the options. And what is unique to this research is, I'm going to spend a minute or two on this one, is the spot volatility, which was proposed by Todorov in 2019. And so what is different from the Black-Scholes implied volatility is that it is more accurate than the Black-Scholes implied volatility, or even if you have some high frequency like realized volatility. For instance, if you're using intraday futures price or returns to calculate the volatilities, tend to be very accurate. But based on Todorov's research, and this spot volatility actually is even better than the intraday volatility, intraday price-based volatility, right? So that's one of the motivation why we are considering this. The other one is the difference between the spot volatility and Black-Scholes volatility is that when we calculate the spot volatility, it includes all the strikes, right? From basically literally from zero strike price to, however, the highest one that is available offered by the CME group, right? Could be from 0 to $10, $15 of strike for even for corn, right? So there's a wide range of theoretically that's available, and that's different. And all strikes are included, and we do extrapolate all the possible option strikes. And as you know, what is actually offered by CME is not like, say, a cent of or 2.5 cents, 2 ticks of the strike would not be available. And so we theoretically extrapolate, and so that it captures the full potential range, right? And so that's what is different. And as a result of including of all the strikes, so it potentially capture the sum of the both ends of the price range. Could be lower price, extremely low and extremely high prices. That's what is make spot volatility more unique. Right. And also we calculate realized volatility from a week to up to 8 weeks. Basically what we're trying to do is calculate the volatility or standard deviation of the futures returns for the next week and up to 8 weeks. And we're trying to predict those realized volatility and see what is the best to predict, which one has the most information. And obviously we calculate the returns, and that's just based on 1 day futures log returns.
All right. So for this data set, we've got futures prices, we've got options prices from regular options and weekly options. And then we had, because of this, we had this Black-Scholes volatility, and then Gerald calculated out the spot volatility, and both of us calculated out slightly different versions of realized volatility. And we'll see how that comes into play, or how that plays out in a couple of different ways here. I started with looking at different report effects. So we went back with 5 years of data and said, let's look at what happens before and after a WASDE report comes out, because those are every month. They're also aligned with crop production report dates. And they're there except for the January 19 one because of the federal shutdown. There's also major reports at the end of every quarter, the grain stocks report, which line up on the same day as prospective plantings and June acreage, and small grain summary reports, January, March, June, respectively. So those are trade dates or major report dates that we isolated. So there were 74 days or dates during the last 5 years where there was one of these major reports. So it gives us a snapshot of high action kind of days. So on days when there's a report, the prices tend to move around more on those days. So days when there's a WASDE report or similar report, on those days for corn, the futures price will move on average 14.2 cents during the day. So the high to the low or the low to the high price range will be 14 cents of variability on days of a major report. Non-report days, price only fluctuated 8 cents. So these reports really matter, and they tend to really result in movements in the futures prices, which is picked up by the volatility and picked up by the option premiums and option prices. Before and after, so just looking at the day before or the morning before, the night before, WASD or other major reports, and then the day after, we can see that the implied volatility tends to be 35% on average for weekly options on days before the report. So leading up to report, you might see a run up in the volatility. Volatility shows up at 35%. As soon as that report's released or after that information from those reports gets incorporated into the market, the volatility falls down to 22.5%. The nearby, which isn't always encompassing a report, tends to be more like a 24% volatility on the day before, and that declines too after that price information is incorporated into the markets. So volatility does rise before and falls after these major reports. When we look at 1 week ahead, so just looking at the last week's lifespan of weekly options and other options with just 1 week until their expiration, for the full sample, a couple things to point out here. For the full sample, the Black-Scholes implied volatility tends to be a little higher on corn than the realized volatility. And then when there's a major report released during a week, the Black-Scholes implied volatility goes up to 25.6% for the week. But then you can see this odd reality. The realized volatility when there's a report week is actually less than a little bit less than normal. So kind of an odd relationship there. And then there's not a report, volatility tends to be less. That same general pattern holds for soybeans. The implied volatility in a report week is going to be, the Black-Scholes implied is going to be higher. And for the sample, the realized volatility was actually a little bit higher in soybeans during report weeks. So you've got a premium in there, a risk premium ahead of major reports, and then that realized variance is a little bit higher during report weeks for soybeans. Here's how that pattern plays out when you look 1 week ahead. So 1 week to go in an options life, whether it be weekly or regular. If there's not a report, you kind of follow pretty much or closer to the 45-degree line between what the implied volatility says, how much prices might fluctuate, and then what's realized, the realized on the horizontal. And then in weeks when there is a major report, then this red line shows up here. It shifts the pattern down. You pay an additional premium in there. You pay a little bit more to offset the volatility associated with a major report. So your implied is higher than or run up relative to what's actually realized. This doesn't mean one's better or worse, or you should use or avoid it, but it's a distinction, and it keeps us interested in learning more about these weekly options and what's happening in the very short run, especially around these major reports. And one last picture on this is just, if you look 1 month out, so 1 month left in an options life, what happens? You're much closer to that 45-degree line, and these seem to be much more consistently fairly priced. So you're paying for about 40% volatility, and you're getting about 40% volatility, or 30 or 20 week in, week out. So it's very well behaved when you start talking about longer lifespans for options. I'm going to turn it back to Gerald for his additional insights on what else is happening in the short run with these weekly options.
Right, thank you, Matt. So before I get into these regressions, I want to kind of highlight the difference between spot volatility and the Black-Scholes volatility, which I kind of mentioned theoretically. There are different spot volatility tend to have a little more information because it captures all the strikes Black shows implied volatility, which is only the strike specific, only one volatility at the money. And so, and just some background information, in both corn and soybean, the spot volatility is higher than black shows volatility as a result of more likelihoods on the both ends, tail ends, right? We're talking about in the 30% range for the black show, for the corn, for the spot volatility, and the black shows, as Matt just presented, was around 20, and a similar story for the soybeans, right? Just keep in mind, spot volatilities tend to be a little bit higher and could have more information, right? So the regression, next slide, the regression, I'm going to just briefly talk about what the regression is. So what we're trying to do is we're trying to predict the volatility, what is going to be for the next week up to 8 weeks. And we want to see for near term, and see a week or two, or up to 4 weeks and 8 weeks, and what is the best predictors of the realized volatility, because that's the important input to the option prices, right? And so you have this RVW, means just 1 week realized volatility for basically for the next week, what is the volatility going to be? And then you have V, which is spot volatility V, right? Under subscript W means weeklies. And then you have BSIV, which is black shows implied volatility under a subscript, that's weekly as well. And then you have just regular spot volatility and regular black shows volatility, right? Horse race among the 4 alternatives of implied volatility and see which one provides the most information in predicting future volatility up to 8 weeks, right? That's one of the key regression. We want to understand what's the best, who has the most information when it comes to predicting future volatility. And let's advance to next regression is about whether the volatility is actually being priced in the futures price, in the futures returns. Left-hand side is the futures returns, the right-hand side is a variety of the implied volatility or realized volatility, and see if they actually reflect this risk-return relationship. As we know, usually higher risk, and we want to require higher rate of return. And for all the regressions, we use up to 5 lag, and to deal with the robustness, heteroscedasticity, and autocorrelation. And hopefully our inference is robust, right? And so here are the results for the corn, and again, realized volatility, and that's what we're trying to predict with all the competitors in implied volatilities, right? And for 1 week prediction, and the R square is 0.4, right? And this is relatively high. We're going to see in a moment. And the significance, you can see the weekly spot volatilities. It is significant. And also black shows implied volatility from the weeklies short term are significant, as well as the regular options that is using black shows implied volatility, right? And just to remember this, the relative significance of the weeklies versus the regulars in terms of their the magnitude, is higher for the black shows, relatively important than the spot volatility, right? So this is the one, just keep in mind. We're going to go through quickly a couple of others. This is the first week for 1 week, and for 2 weeks. And the results, you can see the R square is still quite high, and 54%, and use the same sort of regressions. And now you can see spot volatility is for the weeklies is still significant, but a black shows one is not significant. But the regular options, black shows implied volatility is significant, right? So and then for 4 week prediction, now you can see the R square is much lower than before. We're talking about 40 and 50% for the near term. And all the what used to be very significant, like the weeklies and not so much, and now is regular options is going to be more relevant. You can see the spot volatility and the Black-Scholes volatilities are significant, can be used to predict. And then 8-week, and the R square is only 21%. And similar stories, and the weeklies still have some spot volatility has some predictive power here, but mostly you can see the significant shifted to the regular options, the spot volatility and Black-Scholes implied volatility, right? So for the soybeans, the story is similar, but is slightly different. And you can see the R square now is only 24%. What used to be very significant is spot volatility for from the weeklies, but now it's not so much, but it's shifted to only the BSIV Black-Scholes, both the weeklies and the regulars, right? So you can see the soybeans are slightly different in terms of explanatory power. For 2-week, that is 30%. As you remember, for the corn, we had a 2-week that is 50-some% of R squared. Now it's lower. For the 4-week, similar. Now it's 18%. So you can see the relative magnitude in the R squared is lower for the soybeans up to 8-week, and it's still lower, 17%. And all the significance are basically shifted to the variables and the regular options, both spot volatility and the Black-Scholes volatility, right? So the stories are similar now. I just summarize the regressions for predicting future volatilities for the corn and the regular options using the Black-Scholes implied volatility. That is all significant. So what you know about Black-Scholes implied volatility is still very important, significant throughout the sample. The weekly options are particularly significant for the 1 week, the near-term and short-term predictions, right? The spot volatility is also very significant. That's weekly spot is also very significant. That's the new measure that includes all the information. And the regular options is good for the longer-term predictions, like say 4-week and 8-week. I'm not going to repeat everything for the soybeans, and the story is similar. If we want to predict the near term, 1 week or up to 2 weeks, use the weekly options. And otherwise, the regular options is better for predicting a little bit longer, a month or 2 months and beyond. Right? So that's the predicting future volatilities. This is the weekly option is definitely something new and is also informative, especially for the near term. Right. And the next regression that we run is to try to ask ourselves if actually the risk that is calculated using either spot volatility or Black-Scholes volatility, are they actually priced in the futures returns, right? If we see the higher volatility, will that actually impounded into the futures price? And you can see the R square is very low, which is very typical for this kind of regression. But the point that we want to point out is the spot volatility is actually significant, which is a measure of the risk. In other words, higher risk, and you can see the coefficient is positive, higher risk and higher returns. And that's the typical finance story that you heard from your finance class. That's from the weeklies. And let's move on to the regular corn options. And you can see the R square is barely existent, so it's close to zero. You probably don't want to take too much from this regression. But Black-Scholes implied volatility is significant statistically. So here, again, is positive, high risk, high return. Next one. And for the soybeans, again, barely any R squared explanatory power, and none of the regressors are significant. Implied volatilities, none of them are significant. Right? And the regular soybean options and Black-Scholes implied volatility is still priced, again, is positive. even though with a lower R square there. So that's the return risk and regressions. And you can see for corn and for soybeans, we see the positive relationships, generally speaking, higher volatilities or higher risk and higher returns. And the R square is pretty low for corn, but it's even lower for soybeans. And this is what we have found from our research is the corn market is much more active. And we're talking about weeklies, and its trading volume and everything is about 4 or 5 times more than the soybeans. And in terms of trading volume, open interest for the weeklies, right? So as a result, the statistical results are actually more significant for the corn than for the soybeans, right? And to summarize, and what we found, and we try to ask ourselves, are weekly options unique? And so that it can actually occupy some the space in the options. Yep, we say at least the market participant says, and weekly options are useful and it's gaining popularity. We can see that, and it actually gives us some particular information about events, right? Higher volatilities, implied volatilities relative to realized, and we may be paying some premium, and which is the second question we ask: are weekly options priced fairly well, especially around the velocities and other reports? And we have found an volatility risk premium, in other words, implied volatility that we pay that is embedded in options is higher than what actually is realized, right? We're paying more for maybe a protection, right? So is it priced fairly? Maybe not so, maybe we're paying too much, but there is utility of such protection, right? We are willingly paying higher. Is it too high? And that's not a question we can answer from the current research, but we are paying more, and that's for sure. And the last question we ask is, are weekly options are informative, right? Clearly from the regressions, we see that, especially predicting short-term volatility, and weekly options are more informative, like up to 2 weeks. And if we were talking about predicting beyond a month or more, and the regular options are the way to go. And we can see much more volatility and liquidity in corn relative to soybeans, which we talked about earlier. Right, that's what I have. Matt.
Yeah, so the sort of the take-home messages are that the weeklies versus the regular options, that they are providing some, they are unique. They are providing some different information. You have to pay a little bit more, but might be that there is the trade-off. The overall premium outlay for the weeklies and other short dateds is much lower than a regular option. You pay a little bit of a variance risk premium that might be justified ahead of a major report. And then that distinct information, that's bringing distinct new information to the market about the short run. So if you talk about new crop corn and soybeans, for example, I mean, those expiration days are far away. And the weeklies are providing some different information about the nearby price movement in the market. So I think there's still more to be done in this area, and hopefully Zhiguang keeps working with us on this too. So thank you, Zhiguang. We'll have time at the end here for questions. Heather, I'm going to move quickly through the other content, if that sounds okay yet to you.
Perfect.
So I need to move to stop sharing a second. Getting to another screen here. All right, I hope you can see a screen that says short dated new crop options.
Yes.
All right. This was put together in part with Lucas Caminetti, who's interning with us at SDSU Extension this summer. Short-dated new crop options are options only on the new crop contracts. So they're short-dated because they expire well before the normal options expire. And they're another way to kind of position around, for example, major reports and midsummer growing conditions. How are they different from normal options? They do settle to that new crop futures date, but at forward points in time. So here's sort of a waterfall slide showing when the corn short dated new crop options expire. They're all pegged to, or they're all tied to, the value of the December corn futures price at the time the short dated option expires. So it's not technically deliverable on the new crop contract. It's tied to what is the new crop contract trading at when that option expires. We'll see some specific dates, but you're looking at December corn, November beans, and it's pretty much been it's water under the bridge. Continuing with the waterfall analogy here, the July wheat contract hasn't had any 22 short dated trading for quite some time. They'd all be trading 2023 short dated Chicago wheat options. So that one's really not relevant for now. It's relevant for the 2023 crop year. We'll see some specifics here. We talk about corn next week. The July short dated new crop option expires the last business day with 2 trading days left during the month. It's got rules, but in essence, the July short dated new crop corn option settles, or its last trade date is next Friday. So that's going to be done trading, and it's going to settle to the Diersen corn futures price on the 24th of June. The one that's probably most relevant, same for soybeans, is this August short dated new crop option, which settles on July 22nd. That's going to be the option with the shortest lifespan, settling to the new crop, that trades prior to, or actually has a settlement date after the June acreage report. So that's probably going to be the one that's of most interest in the short run to hedgers and those looking to position around the acreage report. And then also that date is far enough out, it would pick up the July crop production and WASDE reports as well. Eventually, you might see the transition here so that there'd be an August and a September. Once you get to October, in a couple of weeks, they'll start listing the October cereal option. That's not really technically a short dated new crop option. It's the cereal option, the months where there's not a normal option expiring, because it's going to be settling to the nearby, and the nearby will happen to be the new crop futures price. Easy to follow, isn't it? Here's a couple more anecdotes about this. The volume on the short dated new crop tends to be about 10% of the volume of the regular options. So the scale here is about 10 times as small as down here. And the pattern tends to be fairly similar day to day in terms of how much trading happens. The same with soybeans, similar pattern, slightly less than 10% of the volume. Both of these, corn and soybeans, have a fair amount of seasonality in the volatility. And here it is reflected in the short dated new crop volatility. Those were rather volatile early this year on corn, but the last few years, you can see that the volatility tends to peak this time of year when you've got growing conditions and such really messing with prices. The same with soybeans. You tend to have this time of year major reports coming out, acreage report and WASDEs and such, really causing a spike in the volatility observed in those markets. Here's a current look at the corn option term structure for the volatility. So how do you read this chart? Here it says that the nearby, which is about to expire, volatility is 30% new crop. December corn volatility is about 33%. And then these interim old crop contracts are in there with much higher volatility. So inverted markets, futures prices fluctuating, and the spot price being very high right now relative to new crop. That's being reflected here in the volatility as well. We look at short dated new crop. These two contracts, your August and September, they're reflecting very high volatility relative to the regular 33% December corn. These are both at about 40%. So you would be paying a risk premium to lay off the risk associated with the very short time frame, the next month or 2 months in that option. And finally, here's a cost comparison just to kind of show why this might be of interest. If you were to look at a regular at the money put option today for soybeans, new crop, you'd be looking at a cost to buy that option right now, 86 cents a bushel for an at the money option. Now the futures price is 15.45, but a short dated new crop to get you price protection up until the late July, that would cost 52 cents per bushel. So much less time value involved. And if you are looking at how can I get some protection in place in the short run on new crop soybeans, this might be something to at least consider or take a look at or visit with the broker about a little bit more. So you get the trade-off. The out-of-pocket expense is much lower, but you're not getting a full, in this case, a full 6 months worth of protection. So they're interesting, something that's caught our attention and something we've paid some attention to going forward. Heather, how are we doing on time? Should I cover livestock quick or should we go to questions?
I think if you could do livestock quick, we are at 10:48. So if you could cover a little bit of livestock, yeah, hit the good stuff, and then we'll go to questions.
Very good. Got one last screen here. All right, do you see cattle price protection?
I do.
All right. There aren't weeklies, there aren't short dated new crop on cattle, but there is livestock risk protection on cattle, and it kind of fits in with this theme here. So we'll look at some of the cattle price protection tools specific to calves. So here's the price series for 500 to 600 pound steers sold at South Dakota sale barns. I was pointing out last year, 2021, price got up to about 190. Very close to 190 late in the year. This spring, before corn did its tremendous run up, you had some 210 area calves early on, and then last week or a week and a half ago now, super high prices for a week, not inconsistent with sort of that every other week pattern that happens this time of year. But some of the last big runs had a high price level. So some 210. And then if we look ahead to fall, so what will prices be out here this time? That's the time frame we're looking at. So something better than last year would be 190 and higher. Okay, so for perspective, LRP is out there. The big changes with LRP, it can insure unborn calves, and it's just price insurance, just like options. The big thing, if you haven't been paying attention, the premiums now have a 35 to 55% subsidy. So an at the money option might cost $10 a hundredweight for calves, and this subsidy might bring that cost down closer to $5 or $6 per hundredweight. So big subsidy, huge subsidy that moves things. And then another change in the last couple of years is this is now designed for spot sales in the final 60. This used to be a very restricted 30 days of coverage. This now you can have sales in the last 60 days of coverage. So even if there's needing to sell for various reasons, maybe you've got running out of pasture or something like that, you've got more flexibility now with livestock risk protection. Just to show what's happened, almost year to date, almost 2 million head of cattle insured across the country. That's more than double last year and 10 times the amount that was the norm. So that subsidy impact means huge volumes of cattle have been covered relative to where they had been. That 2 million head, how does that play out? Big cow-calf states like Texas and Oklahoma have taken over the top spots in terms of LRP head covered. And then you can see Nebraska and South Dakota both having about 200,000 head insured. The futures price, November futures. So this is November feeder cattle futures. It's gone up to, was this about as high as 187, I think was the high, and it's come back a little bit, but historically running at very high levels, except for that 2014-15 time period. So you have relatively high prices, even with $5, $6, $7, $8 area, for the corn price situation. So what does that look like? LRP on feeder cattle right now. So if we look at this time period right down here, I'm just going to highlight the November sitting with a futures price above 175 right now. After you pay for the premium, it gives you a floor price on feeders of about 170. Biggest interest is on calves. Let's look at those. A steer calf right now, November, typical sale time, 110% of that feeder futures price. You'd be talking about a 195 forward value, and after paying a heavily subsidized premium, you've got an expected floor price. The worst you're going to do is 185, 186, 187 for calves. So how to put that in perspective, if we come back up here, 185, 186, your floor price, the worst with upside open, is going to be better than it's been any time in the last few years. So there you go. That's the nuts and bolts. I'm going to quit talking, so we've got a little time for questions, and certainly follow up if you've got questions on any of this. Zhiguang and I and Lucas would love to visit with you about the details on any or all of these types of options and price coverage.